Hey everyone, and welcome back for another video. Now, many of you know that I am a huge dividend investor and I have a personal goal of surpassing $100,000 per year in dividend income. As a dividend investor, one of the greatest things you can get is consistency. And some of the most consistent and reliable dividend paying companies today are found on the Dividend Aristocrat list. In today's video, we will discuss 3 top Dividend Aristocrat stocks that may be worthy of a buy right now. But before we get started, do me a huge favor and hit that thumbs up button, as that is huge for the growth of this channel moving forward. And if you are interested in investing and dividend stocks in particular, then consider subscribing so you are notified anytime we drop new content. With that being said, let's get started. As always, everything discussed in this video is for educational and informational purposes only, so please do your own due diligence before investing in any stock or ETF mentioned today. In terms of investing, where do you do your trading? What brokerage account do you use? Have you considered M1 Finance? I personally use M1 Finance and they are running a special promotion right now. And if you click on the link down below in my description, they will give you $50 free just for signing up and funding a new account with $100. Also, for my crypto users, if you're interested in cryptocurrency, I hold all of my cryptocurrency, whether it's Bitcoin or Ethereum, at BlockFi, and I earn interest on a monthly basis. If you're interested in this, there's also a link down in the description below where they will give you free Bitcoin for opening a new account. Okay, let's get rolling. For those of you unaware, first I'm going to discuss what a Dividend Aristocrat stock is. To be considered a Dividend Aristocrat, you first have to be in the S&P 500. So not all stocks obviously are in the S&P 500. There are 500 stocks, you guessed it, that was a great guess. So there are 500 stocks that go through their own set of rules to be considered in the S&P 500. So that is the first requirement to be considered a Dividend Aristocrat. The second requirement is you must pay a growing dividend for 25 plus consecutive years. So all of these dividend paying stocks that are on this list have paid a growing dividend each and every year for 25 straight years or more. The third requirement is you must have a market cap of $3 billion plus. So those are the 3 requirements, and really you could see how these reliable dividend paying stocks are found on this list, because a company that's able to pay not only a dividend but pay a growing dividend for 25 plus years seems pretty reliable to me. One of the most intriguing things about dividend stocks is the power of compounding. Now, if you've followed me on social media or even here on YouTube, you know that I love talking about compounding dividends and how they can build wealth over time. Now, there's different speeds that this can be done. If you have dividend growth stocks that are increasing their dividends an average of 10% or more per year, you can see how that snowball can kind of go in your favor, building wealth as you get paid a dividend. You reinvest those dividends to buy more shares, albeit it may be fractional shares, but then the company does it again next year and they increase that dividend another 10%. Now you have more shares plus a growing dividend, and you can see how that compiles over time. Did you know that Dividend Aristocrats actually have their own index as well? It's called the Dividend Aristocrat Index, and over the past decade, the Dividend Aristocrat Index has returned 15.4% per year. And when you compare that to the S&P 500, it has slightly underperformed, as the S&P 500 has returned 16.5% per year over that same period. So with the Dividend Aristocrats, it's been performing pretty much up to par with the S&P 500, plus you're going to get dividends, so make sure you put that into the total return as well. So with that being said, let's discuss 3 top Dividend Aristocrat stocks that I'm looking to buy right now. The first Dividend Aristocrat stock to consider buying for your dividend portfolio is Cardinal Health, stock ticker CAH. Now, some of you may be unfamiliar with Cardinal Health, at least I know I was for a number of years, but this is one of the top 3 largest drug distributors in the US. Other competitors include McKesson, stock ticker MCK, and AmerisourceBergen, stock ticker ABC. The company also manufactures and supplies medical products for both hospitals and labs. And over the past 10 years, the growth in the top line has been quite impressive, with 55% revenue growth over the past decade. Like many companies around the globe, Cardinal Health has continued to invest in their IT infrastructure. One of the areas they're looking to improve is with pharmaceutical distributions, which will continue to fuel top-line growth, but also improve margins. One of the unique things that I found in doing my research on Cardinal Health is that they're actually collaborating with a private company that is involved in autonomous delivery. Kind of a cool thing, considering you've heard that with deliveries when it comes to Amazon, getting your, a drone coming and picking up and kind of dropping off your Amazon. You'll be getting your pills and different supplies from that same drone maybe in the near future. Who knows? But that was kind of a unique thing I wanted to pass on. But when it comes to dividend stocks, one of the other key things that you want to see is the strength of a balance sheet. And Cardinal Health is no different. They have a BBB rated balance sheet with $2.5 billion of cash on hand and very little debt considering the size of the business. During the past year, in 2021, Cardinal Health generated $2.4 billion of operating cash flow, which is another important metric to look at when investing in dividend stocks, because cash flow is exactly where dividends are going to be paid out. And if a company doesn't have the cash flow, then that could indicate a possible dividend cut in the near future. So always take a look at the company's operating cash flow and free cash flow, which takes into account capital expenditures. Okay, next let's take a look at the dividend stats. Currently, Cardinal Health pays a dividend of $1.96 per year, which equates to a dividend yield of 3.85%. We've already discussed the strong cash flows the company has, which is a good sign of a safe dividend. The other is a low payout ratio, and with Cardinal Health, they have a payout ratio of only 35%. They have also increased their dividend for 27 consecutive years now. Now, in terms of dividend growth, which I discussed a little bit earlier, Cardinal Health is not known as a dividend growth stock. They are increasing their dividend each and every year, albeit very slowly, as over the past 5 years, the average annual increase has been roughly 2.5%. Aside from the dividend and turning to valuation, shares of Cardinal Health look quite intriguing. As of right now, the shares trade at a forward price to earnings ratio of 9.5. And if you look at over the past 5 years, the average PE ratio for Cardinal Health has been closer to 10.6. So currently, according to the PE ratio, stocks look a little undervalued. The second dividend aristocrat to consider for your dividend portfolio is Target Corporation, stock ticker TGT. Now, many of you are familiar with this big box retailer, and over the past 2 months, shares of Target have actually pulled back 15%. Like many retailers across the US, this company has seen great headwinds, whether it's inflation, higher transportation costs, or supply chain issues, just to name a few. But as an investor, it is important to consider, are these permanent changes or are these more transitory changes? And in my research and my belief, I am of the opinion that many of these costs are temporary. Transportation costs are not going to be at all-time highs like this. They will come back down. The supply chain issues will get over the hurdle as COVID decreases as well. What these higher costs have done is really impact gross margin, which is a key metric followed by target shareholders. And in the last quarterly results, the company missed guidance by 200 basis points, which is actually a sizable miss on their behalf. In listening to the latest earnings call, it became apparent that management believes a lot of these costs will subside in the back half of the year, which could be a great time to get in now, because this will be a direct impact to not only gross margins, but the bottom line as well. Outside of the higher costs, which directly impact the bottom line, the company has been firing on all cylinders. Over the past 3 quarters, Target has seen double-digit traffic growth, outpacing the likes of Walmart, Costco, and Home Depot in the past 3 quarters. In terms of the dividend, the company has paid a growing dividend for an impressive 53 consecutive years and counting. And they currently sport a dividend yield of 1.58% with a low payout ratio of 27%. Over the past 5 years, the company has increased the dividend an average of 6.4% per year, but management has a goal of increasing that closer to 8% moving forward. In terms of valuation, the company has a forward PE of 17 times and a forward EPS growth expected to be around 28 to 30% this coming year, which implies a PEG ratio of 0.6%. Now, if you are unfamiliar with the PEG ratio, this takes into account the next year's growth and the PE ratio. So being that Target has a PEG ratio below 1, this suggests that the current valuation, when compared to the growth that we're expecting in the coming years, shares of Target are trading at an attractive price. According to 16 different analysts, they currently rate shares of Target a buy with an average price target of $282, implying 22% upside in the next 12 months. So as you've seen, we've looked at the dividend history, and the company pays a very stable dividend. They have a low payout ratio. They're looking to ramp up the dividend increases moving forward, and they have analysts that believe in the story moving forward, that many of these headwinds are going to subside moving forward, and we will see Target get back to its growth because they're getting the traffic, they're getting the top line growth. We just need many of these transportation costs, supply chain issues to work themselves out, and we should see Target excelling in the near future. The third Dividend Aristocrat stock to consider for your dividend portfolio is Realty Income, stock ticker O. Now, many of you know that Realty Income is the gold standard when it comes to REITs. They are a net lease REIT, and we've talked about this in previous videos, but what a net lease REIT is that they own properties, they lease them back to the tenants, and they pass all of those landlord costs on the tenants as well. So tenants not only pay rent, but they also pay property taxes, insurance, and maintenance costs, among other things. The company has a very strong portfolio of properties that is made up of mostly retail properties. But not only do they have strong properties, they also have a very strong tenant base that they work with over 50% of their tenants being investment grade tenants. Realty Income owns over 11,000 properties, primarily in the retail sector, which makes up 84% of total rent. 12% comes from the industrial sector, and the rest comes from agriculture and office properties. Realty Income has been the gold standard for REITs, and they have proven this with their A-rated balance sheet. This strong balance sheet has given them a huge advantage in the market, because as a REIT, you have to go out and add debt or go out to the market and add and raise money. And what they've been able to do with an A-rated balance sheet is their cost of capital is so much lower compared to other REITs, which gives them a huge advantage when they're looking to build their portfolio and operate at a very efficient level. In terms of tenants, Realty Income doesn't just take anyone. They are focused on investment grade companies, with over 50% of their rental income coming from investment grade tenants. Here's a look at their top 20 tenants in terms of rent. You will see some familiar names: 7-Eleven, Walgreens, Dollar General, FedEx, Walmart, and Home Depot, just to name a few. In terms of the dividend, Realty Income is a new member of the Dividend Aristocrat list, which is made up currently of 65 different companies that are on this prestigious list. Currently, shares of Realty Income yield a dividend of 4.13%. The company pays $2.96 per share with a payout ratio of 85%. Now, let me pause for a second, because you may be saying, well, wait a second, Mark, in the first two you mentioned low payout ratio is what we want to look for, and this one has an 85%. Well, I won't get into a ton of detail, but I will link my REIT video that I did that discusses more on the makeup of a REIT. One of the things to be considered a REIT, because you get tax advantages for being considered a REIT, is you must pay 90% of your taxable income back to shareholders in the form of dividend. So you are naturally going to have higher payout ratios when you are considered a REIT. One other thing to add, and why so many people love investing in Realty Income, is the fact that most dividend companies pay on a quarterly basis. Well, Realty Income is a little bit different. They're so different, they actually trademark themselves the monthly dividend paying company. And this is due to the fact that Realty Income pays a dividend each and every month. Shareholders have benefited greatly by investing in Realty Income over the years, and since going public, Realty Income has had a compound average annual return of 15.1%, and the company has paid 617 consecutive monthly dividend payments. The consist of 97 consecutive quarterly increases. So not only is this company increasing on an annual basis, they also increase on a quarterly basis. In this chart here, you can see the increases each and every quarter from Realty Income. Back in 1994, the very first dividend that they paid was 90 cents, and today you can see that the company pays a dividend slightly over $2.95. Realty Income is one of the best when it comes to REITs. You not only get consistent dividend payments, you're going to get a decent yield, as we saw. Over 4% yield is a solid dividend yield that you're going to get, and it's one of the most reliable companies with their A-rated balance sheet with strong cash flows, and they will just continue to get stronger as REITs actually perform quite well in inflationary times. So there you have it, 3 dividend aristocrats to consider for your dividend portfolio. First, we understood what a dividend aristocrat is. You must be included in the S&P 500. You must have dividend payments that are increasing each and every year for 25 plus consecutive years, and you need to have a market cap of at least $3 billion. So these are all stable companies, and as we saw since the beginning of the year, that right now there are 65 companies on this prestigious list. So definitely take a look at each of them. We started with Cardinal Health, then we went to Target, and we ended with Realty Income. And if you're looking for more ETFs, take a look at my latest video here where I discussed my top ETFs to buy in the year 2022. And with that, I hope you enjoyed the video, and please again hit that like button and consider subscribing so that you'll be notified anytime we drop new content. I hope you enjoyed the video, and we will see you next time. Take care.